So here it is, the big one, to buy or to rent. Everyone's got an opinion on this. Your parents, your friends, that guy on the internet. But most of it just boils down to trying to perfectly time the market, which, let's be real, is a total guessing game. It's pretty much impossible. So we're not going to do that. Instead, we are going to build a formula that works for your life and your money, right here, right now.
And here's why this whole thing feels so heavy. It really boils down to this one number, $852. That is the average difference per month between buying and renting in the US at this very moment. You've got the median mortgage payment clocking in at almost $2,700, while the median rent is sitting around $1,850. That gap is a huge financial hurdle for buyers right out of the gate.
Now this chart, wow, this really tells the story. We're calling it the affordability gap. Over on the left, that's what the typical American household actually makes. And on the right, that's the income you need to comfortably afford the median-priced home. The last time this gap was this wide was right before the 2008 crash. So if you're feeling the pressure, this is why. It's not just in your head. The numbers are genuinely tough right now.
But here's our promise to you today. We are not going to waste time trying to predict the future. No crystal balls here. Instead, we're going to build your own personal formula, a clear set of rules you can actually use, based on real data and most importantly, your own life.
So here's our game plan. We'll touch on the dilemma and then dive straight into our 3-part rulebook. We'll start with the hard numbers, then get into your personal timeline, and finally we'll talk about the huge role that location plays. By the time we're done, you'll have all the pieces to make your own decision, totally regret-free.
All right, let's do it. Rulebook Part 1, the numbers. This is our foundation. Before we get into gut feelings or market forecasts, we have to start with the cold, hard math.
And our first tool is something called the price-to-rent ratio. This thing is awesome. It's a metric that pro investors and economists use to get a quick read on a market. It basically tells you if, financially speaking, it's a better deal to buy or rent in a very specific city or even a neighborhood. It just cuts right to the chase.
And the math is actually super simple. Let's just walk through a quick example. Say you're looking at a $400,000 house. A similar place to rent costs $2,000 a month. So first, you take that $2,000 rent, multiply it by 12, you get $24,000 for the year. Now you divide the home price, $400,000, by that annual rent, and you get 16.6. So looking at our little scale here, that drops you right into the maybe zone. It's the market's way of telling you, hey, this isn't a financial slam dunk either way.
Okay, on to our second number. And this one. This is a total game changer, your credit score. This isn't just about whether or not you get approved for the loan. No. It directly controls how much money you'll be paying every single month. It can completely flip the entire buy versus rent equation on its head.
Just look at this breakdown. It's for the same exact house, priced at $435,000. If you've got a decent credit score, say a 717, you might get an interest rate around 7.42%. Your monthly payment is just over $3,000. But if you have an excellent score, an 800, that rate could drop to 6.22%. That saves you over $300 every single month. That's a car payment. So here's the takeaway. Sometimes the smartest move isn't to buy right now, but to wait 6 months and work on boosting that score first.
All right, our next number is a big one, and it's a cost that sneaks up and bites a shocking number of home buyers: homeowners insurance. This is not some small throwaway fee you can ignore. In some parts of the country, this cost can be an absolute deal breaker. And the thing is, this cost is all over the map. It changes dramatically from state to state, depending on the risk of natural disasters. A place like Oklahoma, with all its tornadoes, is the most expensive. Hawaii, one of the least. But check this out. This is how important this is. In California, 7% of home sales are now falling apart after an offer has been accepted simply because the buyer then finds out they can't get insurance or can't afford the sky-high premium. You have to look into this cost from day one.
Okay, so we've crunched the hard numbers. Now let's shift gears a little bit. Welcome to Rulebook Part 2, your life. Because a house is so much more than an asset on a spreadsheet, right? It has to actually fit your personal timeline, your goals, your ambitions.
So you've really got to ask yourself, what phase of life am I in right now? Are you single, maybe needing to stay nimble for a new job opportunity across the country? Are you married with kids and already have a ton of expenses? Or maybe you're an entrepreneur and every spare dollar you have needs to go back into your business. A house is an anchor, and that can be a great thing or a bad thing. You just have to be honest with yourself about whether you need that stability or if it would just hold you back right now.
And this brings us to a fantastic rule of thumb, the timeline rule.
See, buying a house comes with all these huge upfront fees. You got closing costs, agent commissions, all that stuff. It's really expensive. If you think you're going to move in less than 3 years, it's almost impossible to even break even on those costs. Renting just makes more sense. That 3 to 7 year window, that's kind of the gray area. But if you're pretty darn sure you'll be in one place for more than 7 years, buying becomes a much, much safer financial bet.
Which leads us perfectly into our final section, Rulebook Part 3, Location. You've all heard it before, location, 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 and it might just be the most important rule of them all. In real estate, your zip code can change absolutely everything about this decision.
Let's make this super concrete. Let's say your budget is that national median price we talked about, $435,000, okay? In Los Angeles, California, that might get you a 950 square foot condo, if you're lucky. But that exact same amount of money in Oklahoma City could buy you a beautiful 3,000 square foot house. Now, this isn't about which city is better. It's just a crystal clear picture of how dramatically your buying power shifts based on where you decide to put down roots.
And it's not just about what you can buy today, it's about what that investment might be worth tomorrow. Zillow's one-year forecast shows that even if the national market looks kind of flat, what happens locally can be completely different. They're predicting that prices in a place like Atlantic City could go up over 4%. But in Houma, Louisiana, they're expecting prices to actually drop by more than 8%. It just proves that old saying, all real estate is local. And here's one last little piece of the location puzzle that people often forget about. Local politics. You know, stuff like, are there new zoning laws being debated that could allow a high-rise to go up next door and block your sun? Is there a big school funding vote coming up? These local decisions can have a really tangible long-term impact on your property value and just your quality of life. It's a crucial piece of the research.
Okay, so we've covered the numbers, we've talked about your life, and we've looked at location. Now let's bring it all home and put the pieces together so you can make your final decision.
At the end of the day, it's all about understanding the trade-offs. What's the play? Buying now means you start building that equity right away, and you lock in today's price. The big downside, of course, is dealing with higher rates and having less time to get your finances perfect. On the other hand, waiting until 2026 gives you more time to save up, maybe rates will come down a bit, but you run the risk that prices will go up and you'll be competing with even more buyers. There's no single perfect answer here, just a calculated choice.
But here's some reassuring news. The general consensus among the experts for 2026 is a story of stabilization, not chaos. Forecasters from big players like the National Association of Realtors and Fannie Mae, they're pretty much all on the same page. They're seeing modest price growth, mortgage rates kind of settling into the low 6s, a few more homes coming on the market, and most importantly, no one is predicting a market crash. The crazy bidding wars of the past few years seem to be behind us. And this really gets to the heart of it, the ultimate takeaway from all of this. This quote just says it all. The right time to buy isn't about some date on a calendar or a magic market forecast. It's a personal thing. It's that moment when your finances are solid, your lifestyle is ready for it, and you find a home that truly, genuinely fits your life. So, we've built the framework. We've laid out the rules for the numbers, for your life, and for your location. The only question left is the one that only you can answer. Now that you have the tools, what does your personal formula say?